In this video, I'm going to teach you everything that you need to know about the first and most important step to buying a home in 2022, mortgage pre-approval. What is pre-approval? Pre-approval is the process by which a lender determines a potential borrower's ability to pay back the loan that they would be receiving from the lender. This provides the lender with the information that they need to feel confident in loaning the money to potential borrowers. This is important because no decent realtor is going to advise their client to accept an offer where the buyer cannot provide proof that they are able to purchase the property. So how does the pre-approval process work? Number 1, employment/income verification. The lender needs to know that you're going to be able to pay back the money that you are borrowing from them. They are about to make a multi-decade long contract with you that states that fact. So they need to know that you can. So the lender needs to know that you have enough income to be able to pay back the loan into perpetuity. It's not good enough that you have some money in the bank that can pay for your mortgage payments. They're looking 30 years ahead. When that money has run out, they need to know that you will still be able to pay back the money because of your income. Now, when we're talking about employment/income verification, the money that comes in is not the only factor that the lender will consider. The lender is also going to consider the type of employment and the duration of employment depending on the type. For example, I'm a real estate agent here in Louisville, Kentucky, and so in order for my income to be qualifying, I will have had to be in the business for 2 years in order for my income to qualify. A W-2 employee will have verified employment very quickly because they work for someone else. However, if you're 1099, that is, if you're a self-employed individual, then you are going to have to provide 2 years most likely, of pay stubs in order to prove your employment and to prove your income into perpetuity. The lender has to make a bet on the successfulness of your income from your self-employment to be able to gather whether or not they should loan that money to you. The second pillar is your credit score. After a lender has determined that you have enough income to be able to pay back the loan, they need to know that you are going to pay back the loan. And the way that they verify this is through your credit score. You can think of your credit score as a score of your financial trustworthiness to potential lenders. Your score is essentially a metric that measures how likely you are to repay money that you owe. The higher your score, the more reliably that you pay back what you owe. The lower your score, the less reliably that you pay back what you owe. And in the credit world, no credit history isn't any better than bad credit history. Neither a lack of history nor bad history are going to encourage people to give you their money in exchange that you will pay it back with interest in the future. So your credit score impacts your mortgage in 2 ways. The first way that your credit score impacts your mortgage is on a pass-fail rating. The most common loan product is the 30-year fixed-rate conventional home loan. The minimum qualifying credit score for that is a 620. If you ain't got a 620, you ain't getting a 30-year fixed conventional. You're going to have to do some credit repair work in order to make that happen or change to a different program. The other way that your credit impacts your mortgage is through your interest rate. Your credit score is essentially going to determine what your interest rate is. Again, we can think of interest rate as a metric of your likelihood to pay back the loan. The higher that your interest rate is, the less likely the lender thinks that you are to repay your loan. The lower that your interest rate is, the more likely that the lender thinks that you will repay your loan. So if you have a low interest rate, you're going to pay less money per month on your monthly payment because the lender doesn't think that they need to squeeze you for every dime that they can, because they think it's likely that you will continue to pay for the loan and not default on it. If you have a higher interest rate, however, the lender thinks that they need to squeeze every dime out of you because they don't think you're going to be paying for the loan for very long. They think the likelihood of default is high. So if you have a 620 credit score, you are going to have high interest payments. If you have a 720 credit score, which is where your credit score caps out in terms of how it relates to your interest rate, you are going to have the best interest rate that you can, and therefore pretty low payments. After a 720 score, anywhere north of that, the only thing that really becomes affected is your mortgage insurance. Mortgage insurance can be lowered based off your credit score in perpetuity, up to whatever number your score might be. Mortgage insurance is something that you're going to pay if you put less than 20% down on a property. It protects the lender in case of default, and it's an extra charge on your monthly payment. The third pillar to mortgage pre-approval is debt to income ratio, or DTI. Debt to income ratio is a basic calculation that will determine your maximum monthly payment. Your debt to income ratio is going to work like this. The lender will take 50% of your gross monthly income and subtract your debts from that. Debts are anything that you've borrowed from another person. Credit card minimums, student loans, mortgages on other properties. Those things will be counted against you. So the lender will take 50% of your gross monthly pre-tax income and subtract your debts from that. That is the maximum amount that you could pay on a monthly basis. Now we need to talk about your monthly payment. It's not only the amount that you are repaying to the lender on the loan that you made. Your monthly payment consists of 4 things. Those 4 things are represented in an acronym called PITI. P-I-T-I. Principal, interest, taxes, and insurance. Principal is the amount of the loan that you are repaying each month. Interest is the amount of money that you are paying the lender in order for them to loan you the money that they're loaning you. Taxes are taxes on your property. In the United States and most other countries, you are going to pay property taxes if you own a home or municipal services in the area, such as the fire department, road work, and other services. The last thing is insurance. You're going to have homeowners insurance that will be escrowed in or lumped in to your mortgage payment. You also will likely have mortgage insurance that is escrowed into the payment until you reach 20 and potentially even up to 22% equity in your property. The value of your loan is going to be determined by your monthly payment multiplied by the term. For 30-year loans, the term is 360 months. Then you will add in your down payment, and that will be the loan amount. So payment times term plus down payment equals loan value. That would be the maximum amount that you could borrow. So those are the 3 pillars to mortgage pre-approval: employment/income verification, credit score, and debt to income ratio. I also hope that you've learned how important it is to keep your debts manageable. Really, the main thing that impacts your mortgage pre-approval as it pertains to personal finance are your income and the amount of debts that you have. Your credit score is going to determine your interest rate and whether you will be able to be approved on a pass or fail basis. But as far as personal finance goes, the most important factors to consider are really income and debt to income ratio. So it's very important that you are judicious with your debts. Most advisors say that your mortgage payment should be no more than 28 to 36% of your monthly income. So that's it. That's everything that you need to know about mortgage pre-approval. If you have more questions, please leave me a question in the comments below. I would love to hear from you. I'd love to hear your thoughts. And I am a local real estate agent here in Louisville, Kentucky. So if you know folks living in Louisville looking to sell or moving to Louisville, I would love to connect. If you have any kind of business inquiries, my email is going to be down in the description box below. I would love to hear from you. I hope that you guys enjoyed watching this video as much as I've enjoyed making it. If you would like to see more content like this, please subscribe below so that you will be notified when I post more videos. I hope you guys are well. and I hope that you stay safe.